Welcome to Livewire's Alternative Series for 2024. I'm Sarah Allen, and today I'm joined by Dania Zinurova. Dania is a portfolio manager for WAM Alternative Assets. Dania, thank you for joining me today.
It's my pleasure, Sarah. Thank you.
To begin with, there's increasing divergence in global markets. How are you positioned for the coming cycle?
Within WMA portfolio, alternative assets are predominantly investments in tangible, privately owned businesses or assets, or backed by those. So when we look at those asset classes and those strategies, they do tend to have lower and sometimes negative correlation to other asset classes, including equities, fixed income, etc. So to some extent, you know, when my colleagues come in the morning and they get very stressed about the market news and how the market reacts to RBA announcements, etc., it does not affect the investments in WMA portfolio to that point, because the values do not change on a daily basis or intradaily or on a weekly or on a monthly. It's a very different valuation cycle. They go through very different business cycles. All the investment returns from those strategies are affected also by different factors. From the investment returns perspective, or how do I construct my investment portfolio, what do I need to look at? First, of course, interest rates. We are currently looking at a prolonged period of higher interest rates in Australia and overall globally as well. We are still looking in Australia at high levels of inflation. And I look at the asset classes such as infrastructure, certain sectors within real estate, for example, healthcare real estate. Why I look at them? Because they do tend to have very strong inflation protection characteristics. Their revenues, or your income returns, they are linked to annual inflation. So when inflation rises, the income return from those strategies goes up as well. Some asset classes like private debt, they are really good strategies to have in the portfolio when interest rates start increasing. Again, because most of the time we're looking at floating loans. In other words, when RBA goes out and tells us interest rates will go up again, your income return from this type of strategies is most likely to go up as well. And these are the things that they are likely to be less pronounced in other asset classes. Not saying that you cannot tap into those factors, you know, in equities or fixed income, but they are very clear, and I can see it from WMA investment returns. They're very clear in infrastructure, healthcare, real estate, private debt, even certain asset classes where it's probably indirect link, like real assets. And I know we'll talk about real assets today as well. So definitely quite a big part of the portfolio, and the portfolio has really benefited. Infrastructure was one of the strongest performing asset classes, 7.5% yield for the financial year. I think it's really good in this environment. Another factor with this yield is that because contractual revenues are linked to 20, 30, sometimes even longer than 30 years contracts, they are fairly predictable. It's not like this year the yield was 7.5% and then next year maybe it will halve. It's fairly stable and fairly predictable. Very similar in healthcare real estate, because we are looking at leases that are 10, 15, 20 years. So it's also, for me as a portfolio manager, you know, I'll look at my cash flow model and I know what to expect going forward from these strategies. What it's also really exciting for me in this current abnormal cycle is that uncertainty and certain challenges in the market, all this creates a lot of opportunities for private equity investments, because we definitely see valuations of private businesses, they started correcting. So when we were in low interest rate environment, there were a lot of conversations about unsustainable valuations, businesses were overvalued. Now we see those valuations coming down. When we look at the historical data, like even 20 years back, the best performing private equity investments were those that were made in down markets because of this very attractive entry point from the valuations perspective. So we spent quite a lot of time over the last 12, 24 months really identifying those opportunities in private equity and deploying capital in those investments. That's basically how the portfolio has been shaping up.
There are 4 themes you focus on in the portfolio. Can you briefly describe each of these and why you chose to focus on those specific 4?
If I invest today, I want to make sure that in 5, 7 years, those businesses will still be in demand. We tend to focus on sectors of businesses that are likely to be more resilient over the long term. In order to be more resilient, we need to look at long-term economic trends with strong tailwinds. So the 4 themes where I tend to focus: growing aging population. In Australia, by 2050, the population aged over 60 will double in size. The demand for healthcare services will only increase over time. Supply is fairly restricted, and there are some certain structural challenges within the healthcare sector, in particular private healthcare sector. So there are a lot of opportunities to invest in healthcare through alternative assets. And this can be infrastructure. So when we look at some of the hospitals, it can be structured as an infrastructure investment. We can look at private debt, where a loan is given to a healthcare business. We can invest in healthcare through real estate, and we can invest through healthcare through private equity. So some of the examples within the portfolio would be Advara Heartcare. I really like that business. It was a buyout private equity deal, leading Australian cardiology service provider with growing number of clinics across the states. And the growth is still pretty much untapped. Would you need access to cardiology services in 7 years' time? The answer is very likely yes. Are there many groups that can provide high-quality services in this area? No. So this is the way I'm thinking about those trends. And then the other 3, digitalization, that's very simple, no need to explain it. But again, it can be accessed through infrastructure, like digital infrastructure, private equity, and potentially venture capital for the investors who like higher risk, higher return strategies. Growing demand for food, again, that's a very long-term trend and easily can be accessible through a number of strategies. And energy transition or climate change. Energy transition is probably the one that will put a lot of pressure on both institutional investors, but also wholesale retail investors. So that's a very attractive opportunity set for me.
How have you allocated across these themes? Is there one that's probably more dominant across the portfolio than others?
Real assets, well, the trend growing demand for food currently would be the dominant for our portfolio. However, not necessarily on purpose. That's a portfolio that has been, part of the portfolio has been growing over time, predominantly all invested in real assets, some private equity investments in that part as well. What was the driver of growth? One of the allocations there are investments in water rights. The value of water entitlements in Australia nearly doubled over the last 10 years. So the value of investments, has grown exponentially within the portfolio. It performed really well. There are also some investments in agricultural assets. Again, if we look at the value of farmland in Australia and see how the value changed over the last 10 years, grew nearly by 150%. What will happen next year, we are going to start realizing those agriculture investments, so we're going to start exiting them, and the capital proceeds will be coming back to the portfolio, and the portfolio will be a bit more balanced across those 4 themes. But the idea is really focus on the 4 really would be driven by what are the relative valuations across those 4 themes, but also across different asset classes where we can access those themes.
The real assets, which you've touched on a bit as well, is one of the largest allocations in the portfolio. What type of assets within that do you have a preference for, and what benefits do you see this adding to a portfolio?
In WMA portfolio, predominantly water rights and agriculture investments. When I talk about private equity investments, those are more food industry or food sector related. One of the investments is in Retail Zoo. It's a private business that owns Boost Juice and Betty's Burgers, so I put it also in this theme within the portfolio. Benefits, when we think about that, definitely embedded inflation protection. And you might have heard me talking about, continuously increasing grocery spend in Australia. Even when we look at the lower inflation headline number currently compared to last year, the grocery spend or the cost of grocery shopping in Australia continued increasing. Not at the same pace, but it continued increasing. So to me, it's definitely looking at where there is this lack of balance between supply and demand, and where we're more likely to see this cost going up. So to me, that's definitely food-related businesses or agriculture. Something like water right is really very interesting, because water right as an asset class, if we look at the past investment returns from this asset class and see how they were correlated with, let's say, equities, fixed income, credit, we'd find that it's either a very low or negative correlation, because values or valuations of water entitlements, they are really driven by so many different factors. Global trade dynamic, transportation cost, weather condition. For example, while the value of water rights continue increasing and it's holding up really well, we know that the income part from the strategy is heavily affected by weather condition. Because when it rains, the rents for water allocations are going down. So even just looking, 5-6 years ago, when we experienced, pretty bad drought in Australia, 1 megaliter of water was about $900. That was pretty high. If I tell you how much it is now, it's nearly the cost of the drinking bottle water, $5. So this can go up and down, and that's your income as an investor. Why it goes up and down? Because the weather in Australia is very volatile. So when it rains a lot, this kind of rental payment goes down. And that's the good thing to have in the portfolio. You do need to have this asset classes or strategies that would behave differently from the rest, because they bring you very strong diversification.
The private equity is one of the growing segments of your portfolio. What are the key opportunities you're seeing in this space, and are there sectors within private equity that you prefer at the moment?
Overall, private equity currently looks attractive. Still, we haven't seen the number of M&A transactions going up by as much as everyone expected. So overall, the deal flow is fairly low compared to, let's say, 3-4 years ago. Still, buyers and sellers are very cautious around the pricing, around the economic fundamentals, etc. Within that environment, again, very similar. Healthcare is very attractive. I would note, though, that really important to unpack where in healthcare, right? Because healthcare goes through its own cycles. What we see now is that one of the major bottlenecks within the healthcare sector is supply of labor. Everyone is experiencing shortage of nurses and medical staff. So we came across this very exciting opportunity, a business called HCA, Healthcare Australia, and they are one of the major, what they call, supplier of medical nurses. If any of the hospitals is short of staff and they need 20 nurses for the next week, they have a contract with HCA and they contract those nurses to their hospital. It's a really good business to be in right now. It's a growing business with a lot of potential upside. Other sectors, such as digitalization, they're definitely picking up, but still it's probably more within certain subsectors like cybersecurity. Again, because we know cybersecurity is at the front of everything we do now. So businesses that focus on this, businesses that focus on iCloud.
The portfolio held as much as 47% cash a few years back, and it's now about 28.5%. Where have you mainly deployed that cash?
Yes, I remember that. It was quite a moment thinking, wow. One thing before I answer, really, really important not to be scared by that high level of cash. Actually, what's more important is to be very patient and thoughtful when deploying capital into alternative assets and private markets. From the portfolio construction point of view, but also from the quality of the investments. There is really no point to go and try to deploy the capital for the sake of deploying. Most of that capital went into infrastructure, private debt, and private equity. Even when we look at the current level of cash that we report in our NTA reports, it's about 26%. However, it's only 8% that I call pure cash, because the rest has been already committed. We committed and will gradually start deploying this cash over the next 12 months. And this would, most of it, go into private equity.
So my final question is, how can investors use alternative assets in their portfolio, and what type of investors are best suited to a strategy like WAM Alternative Assets?
The benefits of adding alternative assets, they are really very, to me, they're very obvious and very clear in terms of the complementary positive factors that alternatives bring to any investment portfolios. And we talk about this: diversification, potential for outsized returns. Can a retail wholesale investor go and construct a portfolio like WMA on their own? It's going to be pretty challenging. So within WMA, we have about 130 underlying investments. Usually within private equity, minimum ticket size for one investment is about 5 million. So to construct a portfolio like that would require a substantial amount of capital, but also not everyone is prepared to take this illiquidity within their self-managed super fund. So really, I am of course biased, but when I think about WMA, it's a perfect fit of this diversified portfolio of private assets and the listed investment company structure, because it's liquid. It really enables investors to still access this portfolio, but trade in and out every day. So there is no compromise with liquidity. And I think, look, it's even when we look at some of the large super funds in Australia, Australian Super, WAM Super, we'll find in their annual reports that over 30% of their portfolios is invested in private markets. So they definitely clearly see those benefits.
Thank you so much for sharing your insights today, Dania.
Thank you. Thank you for having me.
If you've enjoyed this interview and for more in Livewire's Alternative series, please subscribe to Livewire Markets. Thank you for watching.